Let's take a look at more updates on regional economy. Well, the Vietnamese Prime Minister has signed a decision to ratify an import-export strategy for the period 2011 until 2020 with an orientation towards 2030. Under the strategy, the country's total exports by 2020 are expected to increase by 3 times against an export value of $71 billion in 2010, ensuring balanced trade, of course. Prime Minister Nguyen Thanh Duc has also instructed local industries to restructure export commodities towards industrialization and modernization, improving the export proportion of high value-added products, high-tech goods, and environmentally friendly products. Where the strategy focuses on 4 commodity groups: fuel and minerals, agroforestry and seafood products, processing and manufacturing items, and new and high value-added products. Where the strategy also sets out specific targets. The annual export growth rate will average 12% from 2011 until 2015, 11% from 2016 until 2020, and 10% from 2021 to 2030. The trade deficit will be reduced to less than 10% of a total export turnover by 2015 and reach the trade balance by 2020 towards a trade surplus from 2021 to 2030. The Prime Minister also asked industries to tighten imports in a bid to narrow the trade deficit. To do this, it is essential to bolster production and develop fuels, raw materials, and accessories, as well as support industries. While machinery and high-tech equipment will continue to be imported to save energy and protect the environment, and other import markets should be diversified to guarantee reasonable prices in order to reduce the trade deficit. According to the Ministry of Industry and Trade, Vietnam expected to reach an export revenue of $108.8 billion this year, up 13% from last year, where the import value was predicted at $121.8 billion, a year-on-year increase of 15.2%, leaving the trade deficit of $13 billion. Last year, Vietnam's trade deficit was the lowest in the past decade, reaching just over $9.5 billion, a year-on-year decrease of nearly 23%, half of the government's target of 18% for the whole financial year, the General Statistics Office reported. It has been attributed to the rising export value of nearly $96.26 billion last year, a year-on-year again increase of 33.3%, the highest level since 1995, and tripling the National Assembly's target of 10%. Head of the GSO's Trade Department, Lê Minh Thuy, attributed the high export value last year to business expansion by a number of FDI enterprises. Thuy said that in 2011, the proportion of industrial and mineral products exported rose 4% year-on-year and accounted for 35.2% of total export value.
One of Hong Kong's wealthiest businessmen has warned that Europe's push to recapitalize its banks to contain further shocks to the system could lead to a funding crunch in Asia. Billionaire entrepreneur William Fung said only few in Asia are paying attention to this danger. European banks need more than $100 billion of fresh capital to meet tougher regulatory capital rules laid down by the European Union. They could raise funds through share sales, but the weak market is a deterrent, which means it is more likely that they will pull back loans. The executive deputy chairman of Hong Kong-listed Li Fung, the world's biggest supplier of clothes and toys to retailers, was speaking at a talk held by the National University of Singapore Business School on the future of Asia amid a crisis-laden and flattened world 2 days ago. European banks, more than American banks, are heavily involved in financing businesses in Asia. If they pull back loans, Asia would face a credit crunch. He and his elder brother Victor control Li Fung, which ranked in sales of $16 billion in 2010. Singapore's investment firm Temasek Holdings had a 3% stake in the global trading giant as of March last year, according to Bloomberg data.
Well, Japanese electronics giant Sony has reported another quarterly loss after sales were hit by lower production following the floods in Thailand. The company reported a net loss of 159 billion yen for the final 3 months of 2011, compared with a profit of 72 billion yen a year earlier. Sales fell 17% to 1.8 trillion yen. Well, the firm also blamed weaker demand and a strong yen for the loss. It also forecast a loss for the financial year of 220 billion yen. In November, Sony had predicted an annual loss of 90 billion yen. Well, these figures even surprised analysts. Hisashi Kuroda at Mechiya Yasuda Asset Management said Sony's earnings were worse than he had imagined. Sony has few businesses that have value. The only hope is perhaps film and music, or whether they can make a recovery in the game business. Basically software business, not the hardware one. When a company has struggled in recent years, particularly its TV division, which has lost money for the past 7 years. But analysts said that it has been hit by price falls, an oversupply of panels, and intense competition and innovation in electronics market. On Wednesday, Sony announced that its chief executive, Sir Howard Stringer, would step down from the job on April the 1st to be replaced by Vice President Kazuo Hirai. Sir Howard will stay on as chairman. Well, Kim Young-shan at Shinhan Investment said that it won't be easy for Sony to regain its lost ground under new leadership, as its overall competitiveness has sharply weakened. He said Sony has got structural problems that will take years to fix.